Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending August 14th, 2020. I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra. And this week's theme is when the houses are rocking, don't come a knocking. Let's take a look at where the markets are and where they finished this past week. And then we'll take a look at some charts and just see how things are starting to stack up here. First thing I want to do is I want to talk a little bit about the U.S. Index performance. You can see on a weekly basis, the Dow, S&P, Nasdaq, and the Russell all finished up. It was led by the Dow, 1.18%. Year to date, the only ones that we see in the red right now are the Dow and the Russell. The Dow is down 2.13%, and the Russell is down 5.42%. If we look at some other statistics around U.S. valuations and volatility, you can see the PE ratio. The trailing PE is pretty high at 35.39, and the forward PE ratio is still very high at 26.14. Even though it's lower than the trailing by a little over 26%, it's still very high. And of course, that's primarily because of the interest rates. As you can see, the dividend yield for the U.S. S&P 500 is at about 1.81%, but that's still a wider area from the 10-year Treasury at 70.9 basis points. So the spread is still pretty wide. The VIX basically flat to slightly down for the week, but we've had a lot of down days as the VIX is working off some of its high point from the March 23rd lows. And then, of course, if we look at the sector performance for the week, the best sector was the staples, XLP coming in at a positive 2.39%. The worst sector was utilities, coming in at a minus 2.04%. And then the annual performance for both of the sectors still being led by technology, a little over 21%. Energy is obviously bringing up the rear at 39% roughly. And then if we look around the world for other major indexes, you can see year to date, just about every one of them are in the red except for China. This week, though, everybody was in the green, from the FTSE, which is the London markets, up 96 basis points. The CAC 40, the French markets were up 1.5. The DAX, the German markets, up 1.79. Nikkei, the Japanese markets are up 4.3%. China was just barely above break even, 18 basis points, and then the Hang Seng, the Hong Kong index, was up 2.66. You can see the DAX, the German, which is really the biggest economy over in the 19 countries that make up the ECB. It's only down year to date 2.62%. And the Nikkei over in the Asian markets is down 1.55 for the year. Hang Seng's down a pretty good little bit, which is what we expect. So year to date, the only markets that are in the green that are relatively larger economic powers would be China, and then over here in the U.S., both Nasdaq and the S&P up year to date. Now, if we come over and we take a look at the weekly sound bites, let's just kind of take a look. The market rally, as I said, is continuing up. We're up over 50% from the March 23rd lows. And as I said, we're up 4.4% year to date. So the market, if it officially eclipses this past February's high, and we're all-time highs, and we're pretty close near it, around 20 points or so, it'll be the second fastest bear market recovery in a half century. That's over 50 years. It would only trail the rapid rebound we had in 1982. Okay. This reflects, I think, the unique nature of this economic shutdown and the reopening aspects. Very unusual. Because remember, we went into the fastest ever bear market drop from market peak as well. So we can expect this rapid rise up to move really quick. Now, prior market rallies, if we kind of look at just from a statistical standpoint, where to from here? Well, the last 6 bull market recoveries over the past 50 years, the average return in the first year was 44%. Now, they don't come very easily, right? As the first year experienced several 5% pullbacks. And as it's making its trek here, there's even a 10% correction. Most recently, the recovery from 2009 from that bear market there. We had 5% pullbacks. We had a 16% correction in the summer of 2010, right? So we can expect a lot of chop and pullbacks, not necessarily being a harbinger of a dying bull market, but we should expect periodic setbacks in this strong bounce as we're moving higher. One other interesting stat too, it's been about 100 days since our March 23rd low, and over the past 17 of a total of 18 occurrences, over a big move over a 100-day period like this, the following 12 months have finished positive. So, we got that to look forward to. And while the market's 50% run off the lows have been kind of the headliner, one thing that's kind of taking shape is the tech sector is just getting plenty of attention and fanfare. I mean, the Nasdaq's well into all-time high territory. And then the 5 mega caps in the Nasdaq, Apple, Microsoft, Amazon, Facebook, and Google, they're up about, on average 68% since the March 23rd low. And they represent about 24% of the entire S&P market cap. So we're seeing that narrowing, and just the continued strength of these fangs. I'll take a look at I'll show you guys a Fang Index I created with my charting package eSignal. We'll take a look at that in a minute. But the other thing we're also seeing is small cap equities are up too. They tend to be more sensitive to domestic economic trends, and we're seeing them gain steam as well. We're also seeing some international gaining steam in the emerging markets, equities improving, as I showed you previously across the other global markets. So this is reflecting some early signs, encouraging signs of the global markets trying to make it back. Okay. Now, if we look over here with inflation, because obviously that's going to be the capstone of what a lot of people are worried about, with all this money flowing into the markets. The latest reading this past week showed core inflation. It perked up a little bit. CPI, the Consumer Price Index, rose about 1.6% year over year, up from about 1.2% in prior months. And it's a little bit encouraging because it does show that the market kind of a return of demand from household spending. Okay, yet at the same time, we need to keep a really close eye on CPI and consumer prices, right? Because it plays a key role in what I believe is going to be the future Fed action. Now, the Feds have already come out. The Federal Reserve, U.S. Federal Reserve, has already come out and said they're going to let the economy run hot. So that's helpful. But with inflation still running well below trend, and well below the Fed's target level, we can expect that the interest rates are going to stay low for quite some time. Most analysts are forecasting out to another year or two, and I got to believe it to see it. Or let me say it another way, I got to see it to believe it. But this is one of those kind of things that we got to watch. And we also have to watch the supply chain disruptions that we had during this pandemic, because as things start to open back up, it could create a mismatch between supply and demand. Things could open up all quickly, and then they're not going to be able to meet the demand because everybody's out and they want to spend. They've been cooped up for a while, so they're not going to be able to meet the demand of the consumer when everybody's back. Everybody's buying and spending. That could have a tendency to move inflation and disrupt it just a little bit. But we're going to watch for this and see what the implications are going to be with the Fed. So now this coming week, we do get the Fed meeting minutes on Wednesday at 2 o'clock. So it'll give us an idea of what they were talking about in a lot more detail at the Fed meeting this past July. So let's keep an eye out for that. And then, of course, the U.S. stimulus, current congressional negotiations are just going around and around and around on this thing. So it does represent a little bit of an acute short-term risk. And I know Trump's come out with his executive action, even though negotiations seem to be stalling again with the Democrats and the Republicans. But I believe they're going to come up with some kind of compromise that's going to be reached. And but the longer this thing drags out, the more it can create some bit of short-term risk to the economy, depending on how this thing shakes itself out, right? Now, one other thing too, stock splits are on our mind. Even though we've got both Apple, they're going to do a 4-for-1, and Tesla, they're going to do a 5-for-1 split, both of them set for August 31st. And that's when I think the trade is going to happen for both of those. But we've seen both Tesla and Apple, once they announced the split a while back, both stocks have rapidly appreciated almost 20% each, right, upon the share split announcement. So if we could look at the stats of the S&P right now, the average share price of all the companies in the S&P 500 is about $150 a share. Just 5 years ago, it stood at about $82 a share. So in some respects, splitting stock share price makes sense because it allows it to open it up to more folks coming in to buy. And there's still about 20 stocks out there that are over $400 a share in the S&P. So, those big boys out there, we can look at those: Google, Amazon, and others, bookings.com, some of these big higher price things, will they split? It's hard to tell, but it's something that, just to keep in the back of your mind and how this thing shakes itself out. Now, what I want to do is shift you over right now, and we'll go take a look at some charts. So let me just move my screen here, and I'll move over to look at the E-mini S&P 500 futures. We'll take a look at that for now. And when we take a look, I'm going to wait for it to show up on the screen there so that you guys can get it. What we're looking at here is a daily chart. You can see Friday it closed down 4 points, okay? But you can see here really going all the way back to August 6th. That's about 7 or 8 trading days, 7, 8 trading days. We've been kind of running steady here. I had predicted originally all the way back to early to mid-June, my target was 33.10. We came out and we hit it on August the 5th, right? 10 days ago, 10 calendar days ago. And then we've just ground up higher. I do believe we're going to take out the 33.9750. That's the all-time highs for the futures in the S&P. You can see here going back to May, and if I put it back on early April, which is when we really started our run, you can see the volume over price sitting right under the closing 2019 price there. So this blue dashed line is the dividing line between red and green for the year, okay? This can be a potential stop point. I do believe we're going to come back and we're going to test that again, possibly test the 50 EMA, or in this case, it's an SMA, sitting at 31.91. So let's call it 3,200. You can see if I were to draw a line on that price, it is just dead on. I mean, it's just right there. You can see how often it was tested right around the 3,200, and it held us up very nicely here. And we just came right up over, and then we went away, and you could see all that volume over price sitting right there. Right now, they represent a lot of buyers sitting in here. They just came in and just slowly lifted us up like this. Okay, now if I were to draw a line here and just connect the dots, I'm not doing it very straight, but you get the idea. It's like a rising wedge, and typically with a rising wedge, it tends to be bearish, which means we're going to come back down here. So I would not be surprised over the next 4 weeks. In fact, I was calling for it in July, but we just continued to buy. We had a nice divergence right here from that point and this point right here. I was having folks get into puts right here, and we had a nice move down. We hit my target. The initial target was that yellow circle there, and intraday we came right down and hit 29.30, right? And this was from 32.36 down to 29.30, and we did it in 3 days. So that is, a nice fast move. And then we've been off to the races ever since. And a lot of it is based on stimulus and just continued move higher in the Fangs, because they've lifted a lot of these stocks up, right? Remember, the Fangs, the average is about 68% since the 23rd March lows. Year to date, they're all up, but the average stock, the other 490 some odd stocks that don't represent those 5 or those 4 or 5 behemoths, they're up about a little bit, but nowhere near what those guys are. So we do get that tightening of breath as we're moving higher here. Okay. So I would expect a little bit of move here as we go through August into Labor Day. And then I think we could run up, test this, and just take it out, because markets, when it gets this close to all-time highs, it does like to just kind of run up and take it out. You can see that little very tight range there. So just doing a bop up like that and then back down again would not surprise me at all. In fact, if we take it out, I'd probably be more than willing to just pick up a couple of quick puts to take a quick move back lower again. Okay. If we look at the Nasdaq, I mean, it's continuing to hit new all-time highs here. Okay. You can see here we did have a little bit of a pullback. We had a little bit of a divergence here, what we call a poor man's bed, bearish divergence. You can see all these buying volume sitting right here at that level, and that takes us down to about 10.6. So I was expecting it to come down to around 10.6, just slightly lower than that, the 50 SMA. All right, my target for Nasdaq is up around 11.6. That's my target at this point in time. So any drawdowns in the S&P or the Nasdaq or the Dow or the Russell should be bought. But you want to let that drawdown finish, get a trigger for a long. And for our members this Sunday, I'll go through, the best way to look at that and play it. We've done very well. I had all our members getting long in late March, or in fact early April, and we've just been on a roller coaster ride straight to the upside. It's been really rewarding for us. Okay. And then, of course, if I come back to the E-minis, and then I'm just going to put it on the Ichimoku so that you guys can see that. You can see here on the Ichimoku, I've got a longer term, much longer term potential run over the next 12 months where we can see 3640 in the S&P 500, believe it or not. You can see the green cloud down here. It does show it wants to be bullish, buying on the dip. But again, a little bit of a pullback in my mind, I would feel much more comfortable, right? Taking us down at a minimum to the 3,200, possibly down to the 3,100 would be fine with me, okay? That to me would make some sense. Now let's show you, I want to show you the Fang Index. I've created a Fang Index. Let me just get that chart up for you guys right now. And if we take a look at the Fang Index, you're going to see here where we've had this trigger on a bearish divergence. So let me let it paint the screen for you. And then once it comes up, you can see the trigger on the bearish divergence here with a cross and then a lower cross, and we made a high, and not quite a higher high. We're still at 15,614. Now this Fang Index is comprised of Microsoft, Facebook, Apple. I've also thrown in Netflix, Google, and Amazon. All right, so it really is all the big guys. And you can see here I've got some retracements down here. In fact, I had forecasted a move down to 14, and we went below it intraday, and then we kind of came back up. This is a daily chart, and you can kind of see where we're moving through here. But and this is an EMA, not an SMA, on moving averages. And even then, you can see the wide dispersion of the 50 and the 200, and just how strong these guys have played. I mean, just very strong. Okay, if we come down and we look at volatility, vol is just continuing to go lower. And if you look at this pattern, it's also a declining wedge, which means it tends to be bullish in nature if it breaks. And if we step out, you can see this one is also a declining wedge, and then it broke to the upside, right? So just to give you an idea, I'll just use a bigger pointer, and you could see, something like that, right? And you've got this, and then you can see how, and then you get the spike up, right? You get the spike up, which is interesting because on the S&P, it's got just the opposite, right? It's got something like that, and then you get the spike down on the rising wedge, right? So it does indicate a little bit of a dip should be expected. Remember, volatility is very sensitive in normal markets. On dips, you wouldn't get a wider move in the VIX, but here, because it's sensitive to downside movement, it could happen quickly. You can see we're just slightly not quite into the teens yet, where we closed the week at 2205. I still consider us in like a light red zone, not in the red zone, but just in a light red. Then we get into a caution zone in the yellow before we get back down below about 15, and then we get into the green again. And I've got it color coded, and I label them as zones, and you have to go out to a weekly to basically see them. And these are essentially different kinds of option strategies play well depending on what zone the VIX is playing in. Okay. And zone 5 obviously it's the black swan. I just call it the black swan. It's anything where the VIX is over 50. Okay. And you can see the intraday high here. Or it was up at 85.47 when we, hit the peak, and we were really going lower and we didn't know where we were going to stop. Okay. So the VIX is playing along with us. It's coming back into its own. It's drifting lower very quietly, so that's what lends itself to some momentary shocks, right? You can see here when we had that VIX went from about 24 all the way up to 44, so 20 points in about 4 days. That was that big drawdown, and then it just slowly started working its way back off again. Okay, so just be careful with how these markets look. And if I look at the back month skew, that includes the August and the September futures, volatility futures, we're well into the green. That means we're in a very strong contango environment, which means it's normalized, which in a normal contango structure, the further out in time you go, the higher the vol futures. And that's normal, okay? So we're in a normalized mode here. And then if we look at the front month, which is the current VIX against August, which is going to expire next week, we're in the green, kind of running flat. So there's a little bit more vol baked in the current months than if we go out in time a little bit. If we look at bonds, all right, now bonds did just what I was telling our members. Remember, when bonds are up at 182.21 ticks, I said you want to be looking at shorting bonds. I was having our members looking at TLT to, play it to the downside. As it starts to get down towards the bottom, you're going to flip the switch and go back over the other side again. So again, it's just playing according to the script. And if we look at the interest rates, let's look at the 10-year. If we look at the 10-year interest rates, as I said, it closed the week at 70.9 basis points. Again, it's just the opposite of the bonds. It moves the opposite direction, but here's the range, and sometimes it goes outside the range, and when it does, in this case, it's a clear short, or down at the bottom, it's a clear long on interest rates. Now, you could play interest rates with TBT, Tango Bravo Tango, or you can trade the direction of the bond market, TLT. Tango, Limba, Tango. So these are the ways you want to play these, and they've just been great plays. And there's certain option strategies that just play very well in this. And with the Feds really just messing around here, it's not going to veer too far one way or the other. Okay. If we look at currencies, well, guess what? The dollar, as I've been telling you guys, especially our members, and looking at potential trades, any rally is a sell. Any rally that moves up here, you want to sell. We moved up into this resistance zone. Look for it to come back and retest the 2020 lows, okay, which is around 92.47. By the same token, an easier way to play it is just be long the euro, or the euro futures, or Foxtrot X-Ray Echo, FXE is the ETF that tracks this. Again, these are what I consider to be really interesting, good trades, high probability trades that you can enter. And there's a number of different ways you can exploit this with an option strategy. I mean, we've gone through some of these with our members. I believe this Thursday we'll do an option masters on hedging, which I think should be important for a lot of folks. If you're not a member, I would encourage you to come in and come on and join up. We're having a lot of fun this year, as we did last year. If we look at metals, look at gold. Again, use any bit of a dip as a possible buying opportunity. You can see this trend line here, all right, which started back here in March of this year. We've just been riding this trend line. In fact, this recent dip took us right down to the trend line. Okay, if we blow it up, you can see we almost came down and hit the trend line, right? And then boom, we just came back up. I would not be surprised to see us come back down or run a little bit sideways for a while, okay? Until I think longer term gold is going to be a buy. All right, near term, I think it's going to be sideways and shop. Okay. We had a long entry in gold at about 1600, and I had recommended long silver. And silver was where you wanted to play because on a return on capital basis, silver was clearly the outperformer. The other one that we've been playing long is copper. Okay. Copper's just moved really nicely, got long back over here in early April, and we've been long copper since. The way to trade copper, if you're not into copper futures, would be Freeport McMoran. Okay, and Freeport McMoran is FCX. So back over here, we were getting long FCX in the low sixes. Now it's at 1378. So it's it's more than a double. And then there's ways to add to it with options to enhance your returns in addition to the stock. And you can see my target here is around 1538. We actually came up and hit 1476. So we're missing it by about 90 cents, but this target's been up here. From a timing standpoint, this bar is generated by a combination of fib extensions and GAN. And it just puts it together. I could put both of them on my chart, but just using the bar makes it a little bit easier and takes a lot of lines and drawings off my chart. It's less cluttered, which is why I like it. So this is kind of where we're sitting in the metals market. And then, of course, if we look at oil, oil has just been running sideways. It's a great trade. If your brokerage platform would let you trade oil futures, condors, unbalanced flies, these are the best way to play these right now. Okay, even because it's just not going anywhere. And the other one that has been good for us is nat gas. Look at nat gas; it's going through the roof, right? And we weren't playing. We were playing long, but we were doing bull put spreads. Anytime we got down around 161 down here, and notice it would come up, come down, come up, come down. It did it multiple times. Every time it would hit or go through this 161, it was time to look at a bull put spread in the nat gas futures market, or UNG, but I like trading natural gas futures because you get much more premium on it. Okay. And then you can trade it in overnight hours, so it makes it a little bit easier to play. But this is one of these kind of huge trades. I would not get in front of this and put a credit spread on up here at this time. I'm looking for a dip and then a final run and a bearish divergence, and then I'd be looking for a bear call spread in that trade. All right, everybody, looking at ags, meats, softs, there are some opportunities out there as well as a couple of stocks. Members, I'll review it with you this Sunday evening. If you're not a member, highly encourage you to come in and check us out. Otherwise, guys, have a great weekend. Members, I'll see you Sunday evening. Take care, folks. Ciao.